Deflation is a terrible thing. Inflation you could tolerate.
You can trade anything as a trend fall.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Jason Kelly. Welcome to Bloomberg's Front Row. Today, I'm talking to Joseph Bay and Scott Nuttall, the co-CEOs of KKR, in their first major interview since being promoted to those jobs late last year. Bay and Nuttall now run one of the most storied investment firms in the world. It was founded in 1976 by Henry Kravis and George Roberts, along with their mentor, Jerome Kohlberg. Now, 25 years after joining as analysts, Bay and Nuttall have inherited an even more influential company with tentacles into every corner of the global economy. A pioneer in the leveraged buyout world, remember barbarians at the gate? KKR now spans not just private equity, but credit, infrastructure, insurance, and capital markets, with almost $500 billion in assets under management. Even home base is different. KKR last year moved from its historic headquarters on 57th Street in New York to the brand new Hudson Yards complex on the west side of Manhattan, giving the firm a whole new view. They're investing across the globe, a world roiled by political turmoil, fears of inflation, anxious corporate leaders, and a whole lot more scrutiny.
I think what you're also seeing now is there's a recognition, given the breadth of the industry, the magnitude of what we all do, the responsibility is very large. And that's why I think everybody's now saying, look, we've got to make sure we do this in the right way.
Here's what I talked about with Joe and Scott. Growing up in the modern investing business, the retailization of private equity, anxious CEOs in an age of inflation and volatility, and putting their stamp on the firm. Here's my interview with Joe Bay and Scott Nuttall. Guys, it's really good to be here in your relatively new house. And I have to say, I'd love to start there because this feels different. This feels like a different KKR, different space, new leaders. Joe, what's different about KKR today?
Sure. For those of you, you've been to our offices at 9 West 57th, where we were for 38 years. When we decided to move to Hudson Yards, it was very intentional what we wanted to design. We wanted a physical manifestation of really the firm's value around collaboration, the ability to work together, more collegiality, and we have such a young workforce today, an environment where young people, young demographics would want to come to work every day.
So, Scott, we're going to talk about when you two were younger, and you came in here and came to 9 West, as Joe alludes to, but built on what Joe just said about kind of how it's different, because here in 2022, this is a different firm than what you joined. It's much wider in its ambition to some extent. Put some numbers around that for me.
Yeah, sure. So we are a diversified global firm now. So there has been a lot of change, especially over the last 10 to 12 years. We really expanded meaningfully post the financial crisis. So today we manage approaching $500 billion. It's highly diversified across equity, which is roughly $200 billion with some rounding, 200 in credit, about 100 in real assets, real estate and infrastructure. We're global. So we have 21 offices around the world, about 1,900 people. We own a majority of an insurance company. So the breadth of what we're covering today is significantly greater than what we looked like 10, 15 years ago. The one thing that hasn't changed is the culture of the firm, the DNA of the firm. We still run the firm as one connected enterprise. Everybody participates in everything. And this office, and not only this office, we have a new office in London. We have several new offices around the world that are in this spirit, more open format, opportunities for people to bump into each other, because there's more of us to cover all this ground, but we want to make sure everybody stays connected and that we can continue to make sure relationships travel, ideas travel. That part hasn't changed and will never change. There's just more of us doing it now.
So, Joe, people are going to be watching this and listening to it and thinking, given what Scott just said, that acceleration that's happened over the past 5 to 10 years, what happened? What were the catalysts that sort of pushed you to do that? Because this came at a time, I don't think coincidentally, that you guys were promoted to be co-presidents, co-CEOs, co-COOs, and now CEOs. What happened?
Sure. If you really look at KKR over the last decade, a big part of what we've been doing is really planting the seeds for the future growth, next 5, 10, 15, 20 years. So pre-GFC, we had really basically 6 large strategies and products. Today we have over 30. And as our firm's been growing, it's really a reflection of those strategies just starting to scale. from an idea to the first fund, second fund, third fund, and the globalization of all those strategies.
So give me an example. Give me an example of one of those things that was a seed and now is blossoming.
Well, a lot of what we've found, especially as we go through times of dislocation, is that companies need help. And what we're struggling with is oftentimes the help that they would want didn't work in a private equity fund context. But a company would need financing, or they were trying to do an acquisition, or there was an opportunity where the risk reward wasn't like a private equity risk reward, but what we had done is built views on an industry, relationships with a management team, and we earned the right to get that call. And so the first business we developed outside of private equity was actually in credit, because we found in the credit dislocation in the early 2000s, we got a lot of calls saying, can you help us? And we were trying to take these opportunities and say, could we make this a private equity investment? They didn't need a solution that was equity, they needed a credit solution. We passed on those time and time again, and then we actually kept a spreadsheet of all the things that we missed. Who actually made the investment that we passed on and how much money they made. It was a very upsetting spreadsheet. And so then we said, let's stop saying no, let's have a way to get to yes. And that's how we started the credit business. That was in 2004.
Still have that spreadsheet?
I still have it somewhere, although it's probably in Lotus or something.
Right. So, Joe, you mentioned the global financial crisis, which I think is fair to say is a catalytic moment for the entire private equity industry writ large, for the alternative business. The banks are somewhat, some might say, handcuffed after that, certainly legislated into maybe tighter parameters on what they're doing. How important was that moment for the industry? How important was it for KKR in terms of the opportunity set widening?
Sure. I think when you have dislocations like that, you play defense and you play offense. The defense was on our portfolio companies we had in the ground, making sure they had really resilient capital structures, they were well protected, and we could weather that storm. The offense comes from sectors that are dislocated or where capital's moving away from. And as you referenced, the GFC was incredibly important for private lending in this country and around the world, where the banks were constrained both in terms of balance sheet and in terms of regulation, both in the US and in Europe. And that really created the window for firms like ourselves and others to build large credit businesses to support our clients.
So someone tuning into this might say, oh, KKR co-CEOs, I know those guys. It's Henry and George. Wait, what? Like, here you are, you're new to the job. People want to know who you are. You grew up here in many ways. So let's go back. 1996, you both show up basically at the same time, right? Same class.
That's right.
How does that happen?
Well, we were the two analysts hired in the New York office in 1996. So we were the extent of the analyst class. It was a very
You were
small,
the class.
Yeah, we were the class. It was a very small firm, very small industry at the time. So we showed up. He got here about 6 weeks before me.
I was a senior analyst.
Yeah, that's right. Exactly. He still holds that over me. But
It's like which twin is
the
born
two of us.
first, right?
We sat next to each other, and we really arrived at age 24. So we've now been here over 25 years. So we've spent more than half our lives here together, became fast friends. Our families have kind of grown up together, and we've been very close throughout. So we've been working together for 25 years, and with Henry and George for
Right.
25 years.
Well, we'll talk about those guys in a second, but Joe, take me back to those days. So you get here, this guy shows up. Like, what do you remember? What do you remember about those times, the firm and the meet cute that is the future of the firm?
Well, I think one of the really fun parts of us growing up together, we both showed up married at the age of 24, right? High school sweetheart, college sweetheart. We were married. We had a lot of the same lifestyle, quite frankly, both at work and outside of work. We had our first kids the same year. Yeah. So Scott has 5 kids, I have 4 kids. Our 7 boys go to the same school in New York City. So we really feel like we've grown up together for the last 25 years. The second thing I remember is there used to be a McDonald's on 57th Street that we would go to every night for dinner. So probably not good for us.
We weren't eating healthily.
Wow,
at that time.
that's not the view I have of private equity. Like McDonald's, come on.
Well, we were kind of in the trenches together. There were only 2 people in the office working on all the deals, and so whoever was less busy took the deal. But we were there working away, and dinner together every night, and then we'd spend time together on the weekends. Our families still vacation together. People think we're a little strange.
Yeah.
We spend a lot of time together, but we're really great friends.
And so then there's this sort of critical moment, sort of fast forwarding a little bit, roughly 5 years ago, when Henry and George come to the two of you and say, we're elevating both of you. I think a lot of people watching this who work on Wall Street or know of Wall Street are like, oh, yeah, good luck with that. Like, how's that gonna go? And obviously you had some role models in Henry and George, but those guys are cousins. They've known each other, they've been best friends since they were 7. What was the moment like when it's like, okay, here you go, guys?
It felt very natural, quite frankly. I mean, Henry and George, what they have role modeled for the entire firm for 45 plus years now is the power of co-CEOs, co-leadership. If you have the right chemistry, the right trust, the right communication at the top of the house. And with all the ground we're trying to cover around the world and all these different products, 2 is definitely better than 1. But that chemistry and trust is absolutely foundational to the success.
Yeah, Henry and George's relationship, and the two of them, it's really the DNA of the firm. And if you think about it, that's all we've known, is co-CEO leadership at KKR, and how watching the two of them lean on each other, trust each other, lead the firm for our entire 25-year history here, they really were role models for us as to how do you do this the right way. So we recognize this normally doesn't work. We recognize that it is something that is bucking the trend, but in our firm, it would almost be odd to do it any other way.
Right.
And it's not just us.
No, that's right.
The head of our US business in private equity, we have co-heads. In Europe, we have co-heads. In Asia, we have co-heads. In credit and market, we have co-heads. It is actually culturally for us very, very normal and feels good.
Right.
And if you go back to how much ground we have to cover, the global nature of the firm, the 30 investing businesses, we have a balance sheet, we have an insurance company. It is so much better to have 2 of us, and then we can kick ideas around with each other, counsel each other on the harder questions, and we also still greatly have Henry and George as sounding boards still working with us.
So, Joe, tell me about the day-to-day, because as you said, this is now 30 plus strategies, I believe you said earlier.
Really in 2017, when we became co-presidents, we spent a lot of time thinking about what's the best way to be most efficient with our time and to really make an impact at the firm. And we started this program of majors and minors. So my major is the private markets, right? That's private equity, growth capital, infrastructure, real estate equities. Scott's major is credit, capital markets, insurance, our balance sheet, public shareholders. So we really do spend our time differently in terms of the majors, but we coordinate and collaborate on all of that.
One of the most market shifts it feels like of late is private equity increasingly considered from a retail perspective. This is probably more in your major, Scott. The retailization, it feels like, is one of the biggest sort of mega trends out there. What does that actually look like, and how did we get here relatively? It felt like it was moving along, and then it suddenly accelerated. Sure. What happened?
Yeah, sure. I think the first thing to understand is who we work for, right? We have a huge responsibility. So the legacy of the industry is historically defined benefit public pension plans. So we're really fortunate. We get to work for the better part of 20 million public retirees, teachers, firefighters, policemen and women, municipal workers. And what happens is those defined benefit plans are professionally run, and they have an allocation to alternatives as part of their asset allocation. And that's historically how the industry was built. But at the end of the day, we're really working for individuals. They're counting on us to build their retirement wealth, and they want to make sure it's there when they get to that point. And so if you step back from that and say, all right, how has the world evolved? Well, not only is there defined benefit plans, but there's also defined contribution, and there is an increasing percentage of the world that is actually managing their own retirement wealth for themselves.
401ks, IRAs,
IRAs, you name it. And so it's a bit of an odd dynamic right now if you think about it. If you're a retired teacher in the state of Texas, somewhere between 30 and 40% of your retirement plan is actually invested in alternatives. If you're a retired accountant in the state of Texas, you don't have access to those same investment choices. We just think over time, and I think this is where the industry has gone, is like that's not going to be the case in 10 years. You know, is there an ability to actually take some of what we do and create product that is relevant to those that are managing their own retirement wealth? And so I think what you've mentioned is this, there's been this drumbeat for a while. I think there's an increasing recognition that's where the puck is going, and then people are trying to skate there.
And so does it feel like it's accelerating, and what happens next in this sort of retail, not to overstate it, but almost revolution that it feels like we're in?
Well, I think what you're going to see is a few things. One, you're going to see more products being developed across different asset classes. And so that has started, but I do think that's going to accelerate. And a lot of what you're reading about now is part two, which is, to Joe's point, you've got to build out teams that have a bit of a different orientation, are covering financial advisors, are covering systems in a different way than the institutional coverage model used to work. And so you're seeing firms staff up and actually build those relationships on the ground, because the dollar invested per client is obviously a lot smaller. It's a different distribution effort entirely, so you need to build that out. And between the product build out and the distribution build out, then there's the third question of marketing. How do you get the story out there the right way? How do you educate the financial advisors so they understand what we do, so we can make sure that what we have on the product side is suitable for their client?
I want to dig in on this issue of responsibility in some ways. You guys are top of the pyramid. You are arguably, if we walk down, with all apologies to every one of your competitors, if we walk down a street in New York City or any major metropolis and said, name one private equity firm, many people would say KKR. With great power comes great responsibility in many ways. Especially now, as we talked about, post-global financial crisis, more and more attention is being paid on firms like yours. How do you live up to that? How do you ensure that you're doing right by not just your folks, but your clients, your customers, and sort of projecting that to the world, Joe?
It's incredibly important, and you have to be really intentional, right? I think the two big buckets are probably around sustainability and ESG, where in today's world you have to lead in that area if you're going to be successful, and the other is around DE&I, the diversity equation and really the talent equation. And I think our firm is super forward-leaning on both of those strategic priorities. It's one of the top two things on our strategic priority list in every budget cycle. Maybe I can cover diversity, maybe you talk about ESG a little bit. This industry has come a long way. I think we would be the first to admit there's much further to go in the alternative asset management industry, but the industry itself has made a lot of strides, and there's a really proactive effort to improve the diversity equation. When I joined KKR, I was one of two analysts, but there were virtually no Asian Americans on Wall Street in the early 90s, certainly not in private equity. And the Asian community, I think, is maybe one example of where you've seen meaningfully increased representation. But it's about these new programs. It's about recruiting summer analysts directly out of college. It's about using technology and marketing to get your information out there so you could reach 100 different universities. When we were hiring 5 or 10 people a year, we could just go to a handful of selective universities in the Northeast and probably hire all the analysts and associates we needed. Today, we're literally going to hundreds of different campuses and getting resumes from all around the world, leveraging technology. And that's creating the funnel for us at every single level where we have better and better diversity. This year, we are gender parity when we look at the hiring. Slightly more women actually than men were hired at KKR in this incoming class. And that's the pipeline for talent. Right? Every level, analyst, associate, principal, director, MD to partner, we see a really exciting pipeline of internal talent that will be the future leaders of our firm.
So talk to me a little bit about the CEOs. You mentioned the portfolio and sort of the insights you have and candidly, the influence you have there. What are they saying right now? How are they feeling? I mean, you get a window. I mean, I've jokingly said you guys are the CEOs of CEOs in many ways. You get inputs like nobody else does across industries, across geographies. Generalize for me, Scott, what you're hearing from them right now about the state of the world.
Anxiety. I think there's a real question as to where does all this go? What's going to happen with inflation? What's going to happen with interest rates? What's going to happen with consumer demand around the world? And so what we spend a lot of time on is just sharing with them what we're seeing through our window. So we have meaningful equity stakes in the better part of 250 different companies just on that side of the house. We lend money to 1,400 companies. So we have a lot of data coming into the firm. So we share with our CEOs what we're seeing, and we've built resources inside the firm that allows us to share our views. So as an example, Henry McVeigh runs our global macro effort, and he spends a lot of time with his team trying to say, okay, what is this data telling us? Where do we think the world is going? We share all that with our CEOs and give them our best view as to where the world is going. But that also informs our investment themes. We've been talking about this for a while. Inflation's been low, rates have been low. It was pretty clear at some point we would have more inflation. So as you think about that, you focus on investing in companies that have pricing power. You need price makers, not price takers. So the companies that we've been investing in tend to be on the better side of this, and that's in part why our portfolio has been performing quite nicely. But it is one of these things that we talk about a lot, but I think the overall sense is one of anxiety and question and concerns about where it's going.
And there's a lot of complex issues where they're coming to us not for capital, but really for advice and expertise, to Scott's point. So over the last 5 years, I can't tell you the countless conversations we've had with our CEOs about cybersecurity. It's one of the areas that our technology team and our growth teams invest very significantly. We have resources like General Petraeus at our firm, who is very, very knowledgeable about that whole ecosystem. So we get our chief risk officers together, we get our general counsels at our portfolio companies together, our HR heads together, to talk about tough issues like cyber, for instance, and try to bring them resources to help address that. When we talk about ESG and carbon footprint and what our companies should be doing, our CEOs are reaching out and saying, what are you seeing across your 200 companies? What are the ways in which you guys can help us actually implement strategies? It's not just about the measurement of carbon or greenhouse gases. It's about what should we do next.
I want to go back to what you said about inflation. What's sort of the house view at this point? What are you saying to CEOs? What are you saying to clients about where you expect this to go in the short and midterm?
Oh, we're definitely seeing inflation across the portfolio. I think our expectation is you're going to see it not only in energy and food, but continue to see it in labor. We are having a hard time finding workers in a number of our companies around the world. That inflation, that issue is real and being broadly felt. Our expectation is you're going to have a bit of a spike in inflation this year. It will calm down over the course of the next couple of years. But Henry has a good term, Henry McVeigh, that it's kind of the resting heart rate of inflation is going to be higher. So we're going to see a little spike. Some of that will work its way through the system, and then we'll get down to a range, maybe 2 to 4%, something like that in the U.S. And so what we're sharing with people is that outlook, but we're doing it by market. So same thing, Europe feels closer to recession than we feel right now in the U.S. We're watching housing, we're watching what's going to happen over time with just end demand. But as the consumer goes in the U.S., tends to go the economy. So we're keeping a close eye on what we're seeing out of the consumer.
So on the private market side, Joe, rates have been a very good friend to the private equity market for a long time. How do the contours of sort of private equity, sort of classic private equity, change as the resting heart rate of inflation rises?
Sure. Listen, I think the expectation of rising rates, it's been a risk that we've been worried about for a while and getting ready for a while. I would say as a firm holistically, though, rising rates is actually good for our business. If you think our credit products, 90% of our credit exposure is in floating rate products. So it's not necessarily a bad thing economically for the firm. But as we think about financing companies, we have to be really, really good and smart about risk management. One of the things that we've built, and really to Scott's credit over time, is this really robust capital markets business that sits in the middle of our firm. And that capability helps our companies finance themselves the most efficiently they can and take the least amount of risk. So when you talk about private equity, how do we finance our deals? What do we think about the debt structures? Our capital markets team is an incredible partner to our deal teams. So if we think there's going to be the risk of runaway interest rate increases over time, we are hedging aggressively, fixing out that floating rate exposure in all the companies that we possibly can. And it's a huge part of our risk management kind of infrastructure today, centralized within the firm.
All right, so you go to Henry McVeigh for economics. You go to Mellman in part for ESG related things. You mentioned in passing General David Petraeus. I got to think you're having some conversations with him right now about what's going on in the world and specifically the war in Ukraine. So how do you make that both digestible and then actionable, not just for the firm, but for the broader ecosystem?
First thing we do is we spend a lot of time trying to get to the so what, because there's a lot of information, and so you got to be able to distill it down and say, how is this going to impact what our companies are doing and what our clients are doing? So we try to make sure it's a digestible message, because we have a lot of data, and you got to figure out what does it actually mean. And then what we do, especially in times like this, where there's more volatility, markets are a bit more dislocated, there's more anxiety, is we ratchet up the communication meaningfully. So those three individuals you mentioned and their teams, they're talking to our clients more than ever before. Times like this, we are talking to clients 2 or 3 times the normal volume in a given week. General Petraeus is on calls with investors all the time, talking about what's happening, what he's seeing from his perch. And so we do that with some regularity, but times like this, it's even more significant. Because, to your prior point, with great power comes great responsibility. We need to make sure the market at large knows how we operate these companies, how we are trying to build diverse teams, how we are focused on the environment and different stakeholder groups. And as an industry, we need to keep talking about that.
So Joe, I think about the idea of what Henry and George built, which again, we sit here among it in many ways. You guys obviously were a part of that, but now you're in the main seats. You are the CEOs of this company. So of this firm, what does the Joe and Scott KKR look like that is different? What's the imprint that you guys talk about, because I'm sure you do, that you want to put on this firm as leaders?
I would say what's going to stay the same and perhaps what might be a little bit different. The most important thing is that our legacy around the firm's culture, the collaboration, being a magnet for talent because of our culture, that cannot change. We will absolutely not succeed as a firm if we lose that core part of our DNA. And that is Henry and George's legacy that we are very, very proud to be carrying forward. I think what will change is there's so many more opportunities for our firm to grow. We talked about the wealth channel today, the retail channel. Out in Asia, out in the emerging markets, so much growth opportunities for us. In real estate, in infrastructure, in the climate space, energy transition. The sectors that we can now invest in are so different than maybe 10, 15 years ago.
Yeah, the world's moving faster than ever before, so we have to be ahead of the trends. We've got to be really thoughtful about these themes and then move the entire firm to make sure we're in the way of where the wave is going as opposed to getting hit by it. That is a shift. The world is definitely moving faster. There's also more competition for talent, in everything that we do. And so we've got to make sure people have a fantastic experience here, and that's what we spend a lot of time on, is how do we make sure that we're creating an environment where people want to be, they feel like they have an incredible opportunity to grow, they get stretch assignments, they get mentored. I mean, how lucky were we? We joined this firm when we were 24 years old, and we've been mentored by Henry Kravis and George Roberts for the last 25 plus years. At the same time, we were in an industry that was growing incredibly quickly. I mean, that's a wonderful opportunity. We've been incredibly fortunate. We want to make sure that the Joe and Scotts that are joining now have the opportunities to be in these seats. And now there's lots of people doing this. And so we have to be special and different in a different kind of way, and then aggressively embrace change. Because if we don't, we're going to fall behind.
I want to build on that just for a second, because you said a couple things that sort of put me in a slightly different mindset, which is, when Henry and George started this place, and really through the first few decades, there was a lot of embracing risk in many ways. This was a swashbuckling industry. This was a swashbuckling firm in many ways, and risk was really built in. As you get bigger and bigger, there must be a tendency to play it a little safer. How do you hang on to that willingness to just be like, okay, we're going to do this at a time when the responsibilities are greater? You're not talking about 50 or 100 people, you're talking about 1,900. You're talking about all these different clients. How do you hang on to that edge, which is what made this such a successful and lucrative business over its history?
You got to celebrate risk-taking. I mean, we have a lot of people that have joined just even since the beginning of COVID. We're spending a lot of time talking about, raise your hand, come up with a new idea. They're not all going to be great, but if we don't throw a bunch against the wall, we're not going to find the next big idea. You've got to have a culture where people know it's part of their job and there's a path to success from taking risk and thinking about what might be next. And what we then need to do is we need to celebrate it publicly when someone does that. We need to talk about it internally a lot, so that people know it's, not everything's going to work. Not everything we've done's worked. But if you're not trying, you're never going to have a chance. That's how organizations get stayed and become normal. We don't want to let that happen.
So obviously what you're trying to do now is on a much grander scale than when you two guys come in 1996. How do you go about recruiting not just the future yous, but this much broader firm that you're trying to fill?
Right, it's a much bigger and different job than it was in 1996 when Joe and I joined. So we're doing a number of different things. One is we're starting to recruit people at a younger age. So it used to be we'd bring people in, much like Joe's and my experience, after they spent 2 or 3 years somewhere else, usually in financial services or on Wall Street, where they had some experience and some training. What we're starting to do now is actually hire people out of undergrad. And that's not even early enough. I was on a recruiting call not that long ago, Zoom, which is where the technology is very valuable, with over 500 college sophomores from 86 schools around the country, highly diverse group. So we can actually tell people this is what KKR is all about. And I got interviewed to talk about what we do and how we do it and who we work for. And it's allowed us to create a much more diverse and broader funnel, because we used to only be able to recruit at a handful of schools because there weren't that many of us to go. So that was something that's been a big change and something that we're implementing now, and we're continuing to move in that direction. And sure enough, we're going to have a number of summer interns here at KKR this summer, and we'll hopefully teach them what the industry is all about and then be able to spend time with them and getting to know them. And we're also recruiting from a number of different places that we never used to recruit. So the point of operations and technology that we need to build to operationalize everything that we're doing, we're hiring from and competing with technology companies in a way we never have before. So we have to create a great experience for technologists that want to be at KKR.
And so, Joe, that raises a really interesting question, which I think is, so what's the pitch to some extent? Because it's fairly, straightforward if someone is showing up at Harvard Business School and saying, hey, I'm from KKR. Like, all right, I got it.
There are a lot of great firms out there, but reasons people self-select and want to come to KKR, it's not because of the capital base or anything. It's the experience they're going to have. It's the connectivity with the people, this culture of collaboration that we work every day to build at KKR. And those stories, the social media stories, they ask their friends, what's it like to be an analyst at KKR? We have to deliver great experience so that word of mouth travels to all these 800 campuses that Scott's talking about.
Right.
And I think we've done a better job, but there's a lot more work to do on that front.
As we start to wrap up, I want to go back to this notion of the evolution of this firm that you have seen from the inside out. You show up in 1996, the two of you, and again, it's a well-known firm. There's a little book called Barbarians at the Gate that came out a few years earlier that sort of put KKR on the map and to some extent put the leverage buyout business on the map, for better and worse. And yet, still at that moment, it's a pretty contained, private industry. Over your time here, it has become, in many ways, the opposite of that. It is bigger. It is more influential. Your firm and your competitors are publicly traded. So what does that ultimately mean, Scott, for the responsibility that you have, and how have you seen let me ask the question in a more succinct way. How have you seen the perception of private equity change writ large, and what do you do to help tell the story?
Yeah, I think it's a great question. And I'm not sure we as an industry have told the story as well as it could be told. But back to the job hasn't really changed, because the end result is performing for the people that are counting on us. And back to the responsibility point. We not only have the better part of the 20 million retirees in a pension format that we talked about, the teachers, the firefighters, et cetera, but we also have 2 million policyholders that we work for through our insurance company. We've got countries, sovereign wealth funds that we work for. We have insurers that ultimately are working for individuals as well. And now we're expanding to go more direct to individual investors. So what we try to do is make sure everybody here stays focused on the mission. The mission is performing for the people that are counting on us. And let's focus on getting that right, because they need us to perform so that their lives are what they want them to be. So we try to make sure everybody's oriented around that. We end virtually every firm meeting actually with a picture of the people that we work for, teachers, firefighters, municipal workers, and we remind everybody, remember why we're doing this. That's the end result. That's what we're trying to deliver. For the industry as a whole, I'm not sure we've done a great job talking about that. I think we could do a better job actually sharing what we're doing and the end result of all of this. How it has resulted in incremental benefits to the folks that are counting on us to actually perform for them. And the perception of the industry, I think we've allowed other people to define us maybe a bit more than we should. But what we're doing is not only performing for those individuals, we also, just in our private equity portfolio, we have over 800,000 employees. we've got to do a great job being good stewards for them as well.